What is your life insurance strategy and how does it fit within all 6 areas of your financial life? I've got 3 advanced life insurance strategies you may need to consider. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Life insurance is part of protection planning. Protection planning is part of the 6 areas of your financial life. You need to make sure that your decisions within protection planning are connected to your entire financial life, all 6 areas. Tax planning, yep. Cash flow, present financial position, yes. Retirement, of course. Estate planning, of course. You've got to make sure it's all in sync. And oftentimes we treat life insurance and many other areas, by the way, as separate and distinct pieces. Let me just get this policy over here as cheaply as possible, or because I like this person, I'll get this policy, and it's disconnected to the rest of your financial life. There's 2 types of life insurance out there. There's all sorts of variations of these, but there's really 2. Temporary insurance and permanent insurance. Temporary is term, to where you're renting the coverage for a certain period of time. Okay, I've got this risk that if something happens to me during this time period, there's going to be people that are left financially in a tough spot, and therefore having some liquidity or some resources that get paid out if I pass away, that's needed during this time period. But after that time period, it's not necessary anymore. We're self-funded, we're self-insured, the kids are out on their own, the mortgage is paid off, we're into retirement, that sort of thing. And then there's permanent insurance, and this is, no, I'm going to have people dependent upon my income forever, for the rest of my life, or I've got a key, unique situation that if I pass away, there's going to need to be some liquidity. No matter if I pass away at 35 or 75, there's going to need to be some liquidity. That's permanent insurance. There's not one size fits all. Oftentimes, people have temporary need, but that's where you've got to look at it in the lens of how it impacts and how it connects, how there's synergy to all 6 areas of your financial life. So what's your strategy? Is it just buy term and invest the difference? For many people, that makes a lot of sense, but you've got to work with your certified financial planner. If you're just working with a life insurance salesman, I hate to say it that way, a few decades ago, people were proud to say, I sell life insurance. Now, oftentimes, their approach, because they're not taking a comprehensive approach, likely they're going to try and convince you that you need permanent life insurance when maybe you don't, okay? And I've heard all the strategies, the concepts of infinite banking and a few others that are all sort of gimmicky strategies to say, throw a bunch of money, a lot of money into this permanent life insurance policy, and then you'll be able to borrow money out of it. And guys, these are tools. You've got to work with your CFP to see if that's appropriate, but oftentimes, because of the tax shelters available now and because of the increased fees and inflexibility, yes, you can borrow against your cash value, but outside of that, there's a lot of inflexibility. It's very rigid life insurance policies. Rarely, if ever, do those strategies make sense. So instead, what are some advanced life insurance strategies that may make sense in your financial situation? The first, this one isn't too advanced, but it is laddering term life insurance policies. So getting a term life insurance ladder, and that's sort of just a fancy term for saying staggering the length and the terms of your life insurance. And here's a couple scenarios why or where it would make sense. Say you are a young professional and at some point you're going to have kids, you're going to have a larger house with a bigger mortgage, and there's going to need to be some liquidity if you pass away and you're young and healthy. All those needs aren't there right now, but you're young and healthy, so get some insurance in place, so you get a chunk of insurance in place. Fast forward 6, 7, 8 years down the road, and now you're in that bigger house, you've got that bigger mortgage, you've got those couple of kids, and you say, geez, the life insurance that I got back before is no longer adequate. I need more insurance. Well, instead of canceling the policy that you already have that you got when you were young and healthy, you keep that in place and you ladder on another policy that has a different term to it. Okay, so that's one type of life insurance ladder. But the other one is a little bit more specific and intentional. And that is where, and you've got to run the numbers on this because it doesn't make sense in every situation, but that is where you're at a certain season of life, point in time, and you say, well, through our needs, our life insurance needs analysis, we need life insurance of this amount for this long. But after that, after the mortgage is paid off or after the kids are out of college, like we've got twins or whatever, and the youngest are twins, and when the twins are off on their own, our life insurance needs going to drop significantly. So we need $1 million of coverage, but $500,000 of that can be done in 20 years, and the other half we want to extend another 10 years beyond that and get us to retirement. So maybe you get two different policies, a 30-year for $500,000 and a 20-year for $500,000. You'd have to compare that with just getting a 30-year for $1 million and dropping that death benefit after 20 years. But those are a couple scenarios where you may want to consider laddering your policies. Again, not for everyone. Work with your certified financial planner, see if that makes sense for you. A second advanced planning life insurance strategy. This is one that used to make a lot more sense, and this is the type of insurance we have. Some of this type for me and Cindy. You've got to run the numbers. You've got to see if it makes sense for you. But that is return of premium life insurance. Return of premium life insurance. This overcomes one of the biggest gripes with life insurance or term life insurance, and that is, all right, so you bought $1 million policy for 20 years, you pay into it each and every year, and after 20 years, you're still alive. So what happens to that policy? It goes away. And then people say, wait a second, I put all this money into it and I didn't get anything out of it? No, you won. You're still alive. Like you were renting the coverage. You were renting the coverage while you needed it. And after the 20 years, the rent stopped. But you never owned the house. You didn't own the life insurance, and you won. You didn't pass away. In order to get something for your money, you would have had to die, and then you would have gotten an amazing return on that premium that you paid. But that's the worst case scenario sort of thing. A return of premium was sort of emotionally designed to overcome that, but mathematically it can actually make a lot of sense. So here's the concept. Say, for example, that $1 million for 20 years, say it's $1,000 a year to rent the coverage. That's your premium. Well, also take a look and see, well, what if we do a return of premium life insurance, and for that same $1 million for 20 years, say it's $1,500. So an extra $500 a year for 20 years. If you do that, at the end, after 20 years, the life insurance goes away and you get all of your money back. You don't get that extra $500 back. You get the full $1,500 back every single year. So $1,500 times 20. You're going to want to do the math to say, all right, well then what's the return? What return did I get on the extra $500? Because you might say, you didn't get any return. They just gave you your money back. No, you were going to pay $1,000 anyway. And that money would have been gone. So you pay an extra $500 to get that $1,000 you wouldn't have gotten to get that back. Do that math and do that return. If that return is 2-3% over that time, you might say it's not worth it. If that returns maybe 6 or 7%, you might still say it's not worth it. If you're max funding all of your retirement accounts and you're filling up all your tax shelters and all of that, and you still have some extra resources, or maybe you have some cash flow goals that arrive right around that 20-year mark, you might look at that return and say 6-7%. I can probably get a better return somewhere else, but you know what? In my situation, it might be worth it. For us, the calculus was a little over 7% rate of return. If we just went with the lower term or just the regular term, we weren't going to save more. We were already saving as aggressively as we possibly felt we could. And we thought, well, in 30 years, the kids would be out of the house and maybe we'd use this to either help with our retirement or help them with a down payment or buying a vehicle or something like that. And so for us, early in our career, it checked out. Recently, we've had to ladder some insurance policies on top of it, and the math didn't work for a return of premium policy. But do that math, see if a return of premium life insurance policy makes sense for you. And then the third advanced life insurance strategy that I'll introduce here. I'm not able to talk about it in detail. It's just going to take a lot of time. That's for another video. But it's for an estate enhancement. An estate enhancement. Think of it this way. When you get into retirement and through retirement, maybe into your 70s, and at that time, you're forced to start drawing a minimum amount out of your IRAs, and it's taxable to you. But if you've saved up enough, or if your lifestyle is such, or basically if your financial plan is structured in such a way that you're not going to spend through all of this money, and you're looking at, the kids, the family, like I was hoping to leave an inheritance, and yep, I'll be leaving an inheritance because we don't need this required minimum distribution money. We're just forced to take it out. Well, then in that situation, the kids or the family is going to inherit those assets. They're going to inherit that IRA. It's going to be taxable to them, and now they're going to be forced to draw all that money out within 10 years, so the taxes could be even higher. What if instead you bought a permanent life insurance policy at that time, and you used that required minimum distribution to pay the premium on that? And then what would happen? Well, I'm taking my required minimum distribution, and so my IRA is, fluctuating in value anyway, but this life insurance policy is being funded, and when I pass away, that life insurance policy is going to be inherited by my beneficiaries. Is that life insurance policy taxable to them? No, it's not. You've just enhanced your estate, the amount of inheritance that your heirs will receive, and done so in a tax-efficient way. Even if the premium required for that life insurance is above your required minimum distribution, you're parlaying, you're turning your taxable life insurance, taxable IRA into a tax-free, potentially multiple, because of leverage, a multiple of the size of your IRA, turning it into a tax-free inheritance instead. So not right for everyone. And certainly, there's a lot of things that need to line up, but that's a third advanced planning strategy that you should consider. So work with your CFP on any of those. So, part of being, part of the role of your certified financial planner is creativity, creative solutions to your financial situation, and then taking a look at all 6 areas of your financial life to say, well, hey, does this creative idea, does it make sense for you? Or no, it would actually be at odds with your present financial position or your investment planning, or it'd be at odds with something else. Well, all right, it was an interesting idea, it doesn't fit for you. Or no, this interesting idea, it would improve your estate plan, improve your tax picture, improve your cash flow. Yeah, that's one we should consider. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.